be a mystery to you, which of course implies that number one, you may know what those option Greeks are and that they have been a mystery thus far. That may or may not be true in your case, but we are going to make sure that as you walk out the door today, that you do know what they are, understand their uses, and are able to apply that yourself in your options trading on an ongoing basis. But because this will need to be tailored to the specific people here in our audience, would you please be so kind as to go ahead and use the question and answer tool down at the bottom of the screen. Go ahead and let us know your questions in regards to the option Greeks. We'll talk about what they are, how to use them, and also show a few different examples over the course of the session. I'm excited to do that and make sure that we walk through these things. We have a lot of different information along the way, and we are certainly happy to do so. We did receive a question right off the bat, so let me address that. Clab, you were wondering about how to access some of the recorded content we have on fidelity.com. Let me go ahead and show you where you can access that. You're going to head to fidelity.com, and you're going to make use of the search bar in the top right-hand corner. This search bar in the top right-hand corner, this topic that you were looking for, specifically, I would encourage you to search option series. Option series and hit enter. And you'll notice this very first link right up here at the top is options trading at Fidelity. That's a recorded version of the same material that makes up our 4-week classes. So sorry you weren't able to find that on your own or with the other help you had sought out. Now, there is going to be a number of slides available, AR, for this class, but only during the course of the class. We don't have a way for you to download these directly. If you want to take screenshots, of course, more power to you. Feel free to do so. We'll be walking through this, and hopefully it will all be understandable enough that we can get you up and running along the way. All right. What we see right now is that our first plan is to get to know what the Greeks are. Then we're going to think about how to manage option trades on an ongoing basis and planning out option trades in the future. So let's start with the getting to know you. Let's introduce the Greeks, and maybe we should start with why in the world they're called the Greeks. That's because we borrow at least a few of these from Greek letters or words: delta, gamma, theta, and rho, each being Greek letters. Vega is thrown in because it sounds kind of Greek in nature. It is not in reality, but nonetheless, Vega being thrown in there as the bonus, sort of Greek, but it does fit with the other 4 here on the page. That's why we're going to include them. Each of them tells us something different about how our options price will change. If something else changes, some outside factor will change, and that will impact your options trade. So what would they be? If we look at delta, delta is the measure of the rate of change in the options value for a change in the price of the underlying. Now, don't worry about the very verbose definitions that show up on each of these, a 1-unit change, etc. Delta is measuring if the stock goes up by $1, how much does my option premium change? That's delta. Stock moves by $1. Gamma, then, is how much delta will change after moving up that $1. So if the stock was at 50 and it goes to 51, we're going to see the option premium go up by delta, and then delta will change by whatever gamma's value is. That's going to result in this kind of acceleration in your change in price. You could think of delta as the velocity, gamma as the acceleration, if you want to put it in physics terms. Next, we see Vega on the list. Vega is going to measure how much your options price will change based upon a 1% increase in the implied volatility value. 1% increase in implied volatility. We'll look at implied volatility in a number of different ways later on in the class, but that's what Vega is all about. If implied volatility has changed, how much will that impact my options premium? Next comes theta. Theta T for time. As we think through each one of these, we can see some of this tied together. D for delta and direction. V for vega and volatility. Theta T for time. Theta is how much your option will change in value based on a 1-day passage of time. 24 hours passes, and what happens to my option? Well, it's going to change in value as a result of that time ticking away at the overall value remaining in your option. So we've got 4 of them defined to some degree. This last one has been certainly in vogue over the course of the last year or so, as we've seen the Federal Reserve makes dramatic changes to short-term interest rates. That has made questions about interest rates and their impacts on options more relevant than they have been in the past. Nonetheless, I will tell you that rho, though it measures the change in your options premium in relation to a 1% change in the risk-free interest rate, it's only going to be relevant for options with a relatively long time frame. If you think with me about how you consider your money, probably the money that you're about to spend sits in a checking account that either earns no interest or a very small amount of interest. But the money that you want to save up for a little while, maybe for a rainy day and emergency savings, might be sitting in a savings account, which earns a little bit more interest, maybe 1% or 2%. Whereas the money that you have for long term, for 3 to 5 to 10 years, all the way out until your eventual retirement or until the end of your days, those are dollars that you've got invested for the long term in the stock market, in the bond market, earning higher rates of interest. That's because we start caring more and more about the returns for the longer term. There's also some stability discussion that we'll step aside from today. But when we think about options, the same is true. Very short-term options have almost no impact as a result of a potential change in rates, whereas the longer time frame of your option, the more that might take sway. Nonetheless, rho is usually one of the minor aspects in relation to these other 4. But nonetheless, these Greeks are here, they're present, and they are here because they're going to help us understand how an option would change. But several times here on this slide, we're seeing the word theoretical, 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 theoretical. So why are we talking about theory here? I want to trade in the real world. The reason is these will help us understand how your option will change based upon your outlook. Let's suppose that you've given some thought to ABC stock, to XYZ stock, to whatever stock you are watching, and you've decided you think the stock will rise. Suppose you think it will rise by 5%. Will that generate enough of a profit for you to justify buying a call? Or will that be better suited for selling a put, both of which are bullish strategies, both of which profit from that increase in the underlying? But which would be more profitable? Which would be better suited given the other things you're thinking about? Most of us approach trading with at minimum a directional outlook. Delta, we're pretty good at as traders. I think the stock's going up, going down, going sideways. Vega and theta sometimes we omit, and we should not, especially as options traders. Let's jump to theta. Theta is time, and time is important for an options trade. Just like a gallon of milk has a specific expiration date, and the closer and closer the expiration date looms, the more likely the grocery store is to put that on sale, on deep discount, because now there's less time for a prospective buyer to make use of the milk before it curdles. Theta is that for options. You should not buy an option without looking at the expiration date. You should give thought to when your directional movement is expected to occur. Do you expect the stock to rise 5% after its earnings that's about to happen next week? The timing matters. Do you expect the market to rise substantially or fall dramatically after the upcoming presidential election? The timing matters. Theta will change our options value during the lifespan of our trade. Theta works against all options equally. It works against calls, it works against puts, it works against anybody who is a buyer of options. However, if you are a seller of options, theta instead becomes your partner in crime. It is your ability to generate ongoing profits as it ticks away at the value of an option over time, leading to some potential profits. But how much does that happen? And does it change at a constant rate? The short answer is no, it does not. And so we will theoretically calculate if my stock will rise by 5% by 3 weeks from now. Well, I've now got 2/3 here of a pretty solid idea related to my stock, an outlook. I'm still missing V for Vega and volatility. What will happen during that time frame to expectations for future volatility? I already understand a little bit about what I expect for the stock to do. I expect it to move up by 5%. That's some part of the volatility. But implied volatility is how much extra the options market is forecasting in terms of that change in price. So this is our first glance, and we're going to dive deeper into each of these and see them in live scenarios. But I hope this is a starting point to understand what the Greeks are. Maybe this was the mystery you entered the class with. From now on, we're going to do our best to demystify these, make them very approachable and useful to you in your option trading going forward. So, Matt, without further ado, I yield the microphone to you, my friend.
Yeah, appreciate that. And that was an excellent kind of initial glimpse into the definitions for all of these. And that's effectively what you're going to see on the screen right here. I'll just leave that up for a second for anybody that is wanting to maybe visually see what Jake was referring to. And then we'll dive into each one of these one by one, starting with Delta. And first of all, I just want to commend the group that we have in here today, because I'm seeing some absolutely fantastic questions in the Q&A, and we want to address those, and we're going to live here because there's some really good ones out there. And if you have more, don't be shy about putting them in. But we'll skip over this one here because I do want to talk about the important part here of the options Greeks and just options in general, which is it's not like a regular stock. A regular stock only has intrinsically what it's worth, right? You buy it at a certain price and you make money if it goes up, you'll lose money if it goes down. However, options are going to be just a little bit more complicated than that. And the reason I say that, of course, is because they have this secondary component, which is called extrinsic value. And the extrinsic value is basically what an option is worth outside of just the intrinsic part. And you're seeing this on the screen here. We're looking at a stock that's $74.73. And we're looking at calls here. And when we go and look at the ones that are below the strike, below the current market price, well, they're going to have both. They're going to have intrinsic value because think about why that is. If we're buying a call option with the strike of 65 and the market is at 74.73, we know for a fact, even if there was nobody on the other side willing to trade this option with us, we could always exercise the option. We could buy the shares at $65 and turn around, and we know that we could sell them at the current market price, which is $74.73, or, by the time it all gets done, somewhere around there. And for that reason, we take the difference between the two, and it's creating the intrinsic value. Notice when we slide up the option chain, or down, I guess I should say, up in terms of strike, when we get outside of where the current market price is, so we can even go to $75, and this is the first time on this particular chain we'll see intrinsic value of zero. It's not worth anything intrinsically because, well, we can buy at 75, but we could sell at 74.73. That's less than where we can exercise our option and buy the shares. So, of course, none of those above 75 or 75 itself are going to have that intrinsic value. Whereas you'll notice for all of these options, they're going to have time value. And why is that? Well, the reason why is because there's two factors at play. There's the value associated with the time left to expiration, which is why extrinsic and time value, they're often interchange terms. But then there's also a volatility component that's here. What is the market actually pricing in terms of what they think the stock could potentially do? Not what it's going to do, but what it could potentially do, or maybe the best word to describe this is what it expects the underlying to do. And ultimately, when you're doing an option trade, the fundamental question that you're trying to ask yourself, yes, is it the direction or the neutrality of the underlying move? Absolutely. That's a very important question. But especially when you're dealing with the directional moves, or I mean, even neutrality, when I think about it, we're really trying to encapsulate, is it going to be greater than what's being expected or implied in the price of my option, or is it going to be less than that? And when you come to an understanding and a conviction on which one you believe, that's ultimately the determining factor as to whether I want to be buying this option or selling this option, or potentially there's a third scenario here where we're just completely sitting it out because we're not really sure one direction or the other. So that's what we're thinking about extrinsic. And these options Greeks is very important to understand. It's only affecting the extrinsic value. Otherwise, it's just behaving as stock, right? So important to understand that question. Now, the first one we're going to talk about, and again, this is more just of a definitional slide, but there's a couple other pieces of color here that I want to throw in. And first and foremost, it's exactly like Jake said, what delta is actually describing to us is what is the options response going to be in terms of. So if we're looking at a positive delta, what that's trying to tell us is if the underlying stock were to go up by $1, this is how much we should expect, all other things being equal. And in effect, if it happened instantaneously from the moment that we're looking at the option and the delta, if it happened in that exact second, that's how much we should expect the option to go up by. So in the case of a long call, if you're looking at a 50 delta, we call it a 50 delta, but really when we're looking at the value of delta, we're sliding that decimal over 2 spots to the left, and that's creating a 0.5. So if the underlying stock were to go up by $1, we should expect the option to increase by 50 cents. Now, vice versa, if we were looking at a situation like a put, for example, and whenever we're thinking about Greeks, this is also an important framework to understand. They're always quoted, or the values that you're seeing on your screen are always from the view of the holder of the option, meaning the person that's buying the option. So when we go over and look at the deltas on puts, well, they're all going to be negative. Therefore, if the stock were to go up by $1, right, what would the put do if it had a negative 50 delta? Well, it should go down by 50 cents. So that's the basic mathematical formula. It comes from Black-Scholes, well known and well disseminated. But there's a couple of other things or uses that we can do with delta. And I think this is really where it starts to get into the practicality. When you're starting to think about how am I trying to express myself with a nuance in accordance with my outlook. And the first one that we're going to talk about here is it's also a share equivalency. So if you're buying a 50 delta, it could be thought of like you're buying 50 shares of that underlying stock. As we increase the delta, it's like we're buying more shares. As we decrease it, it's like we're buying less. Now, there's a trade-off here. which is the higher we get in terms of delta. And just think about it from the call side is probably the easiest way to think about it. When we're thinking about it from the call side, as we go from 50 to 60 to 70, we're getting an option that's going to be more responsive to the underlying move. But what's also happening is we're also going to be paying a higher premium for those options. And that's why we're getting the higher delta. And eventually, if we were to continue to go higher and higher and higher, we're going to run into a situation where we could be at 100 deltas. Well, if we think about what also has 100 deltas, that's just buying 100 shares of the underlying stock. So, what am I saying? What I'm saying is that as we get higher and higher in delta, the option becomes more and more less like an option and more like the underlying stock itself. Now, when we start to go the other direction, it's the exact opposite condition. It's becoming more like an option because the probabilities are going down that it's actually going to be in money at some point. However, we're getting a secondary feature, which is we're paying less premium. Therefore, we're getting more leverage, but we're still at the end of the day controlling 100 shares by expiration. What we need, though, is an extremely larger move in order for this thing to potentially turn into a profitable option by expiration. And that's kind of the trade-off. So in one variation, you're getting more leverage, and the other, you're getting more like the stock. Now, I think probably the best thing to do here is just to go over and look at an actual option chain because we can talk about the theory and I like to go through some of the slides, but I also just like to show everybody what it is that I'm actually talking about. Let me switch over to SPY actually, and we'll utilize this one. And I won't use July. Let's actually go out to August here. And why don't I throw 20 strikes on? And you're already going to start to see some of the components of another Greek, which is that row feature, because in a more normal environment, you're going to typically see, and when I say more normal, that's probably a bad way of phrasing it. In a lower interest rate environment, like we're used to, I say more normal for probably the last 20 years or so, or maybe even the last 15, we're in a situation where, and we're going to close out of that. So what we're doing here is basically seeing a situation where row is going to be affecting the deltas, and the at the money deltas, they're usually 50. But if we look at this particular option, and Jake, thanks for pulling that up for me. When we're looking at this particular option that's at the money, 556, 557, we can do whichever one here. You'll notice that they're a little bit higher than 50. And it's not by much on SPY, but if you look at some further out options, especially, that's where it starts to get, really, really drastic. I mean, yeah, if we wanted to go out to like the end of the year, even, you'll start to see that condition. So if we look at the 555, we'll now look at the delta here, or the 560 even. They're 62 and 59 respectively. And that's what Jake is talking about when there's a cost to carry and row being higher. It's affecting the options more because if we didn't buy this option, we would just have cash. It could be parked in a money market, and therefore we could be gaining interest. And that has to be reflected in the price of both calls and puts. So what we're looking at here, though, as we go down the option chain or lower in strike, we're going to see deltas at the 510 all the way up to 82. So what is that telling us? Well, it's telling us that if the underlying stock were to go up by $1, we should expect that option to go from, and it's a little bit of a wider spread here, but let's say $65, $65.25, we should expect it to go up by 82 cents, or we should make $82 in that particular scenario. Now, the other thing about Delta that we can use this for, it's also an approximation of the probability of us being in the money by expiration. And that's a very, very important thing to understand because what all these options and, any kind of mathematical formula that we're using to price these, at the end of the day, it really boils down to probabilities. That's how, people are deciding what premiums to pay. What am I willing to pay based on the probability of this thing being here by this date or here by this date? And that's what you're seeing reflected. So as we go deeper in the money, we're paying more for the option. We're getting a higher delta, so it's going to move more quickly, or I shouldn't say quickly, it's going to move in a greater magnitude than something that's out of the money. And we're also getting a higher probability of chance of this thing finishing in the money. Now, it's not saying it's going to finish where it's at right now today, but there's an 82 or almost 83% chance we're going to be above 510 by January 17th of next year. When we go all the way to the other end of the spectrum here, when we're looking at the 605, well, now we're getting the opposite condition. We're paying way less. We're paying a tenth effectively of what we're paying for that 510 option. So that's that leverage component. For the same money that we would spend on a 510 strike, we could buy 10 of the 605s. Well, what's the difference here? Well, with the 510, we're still only controlling 100 shares of the underlying. With this one, if we spent the same money, we could be controlling 1,000 shares. But what do we need to have happen? We need it to not just stay where it's at. We don't need it to just go up a little bit. If we get to expiration, we're at 604 and 99 cents. Guess what? We have a worthless option. But what makes these attractive is, well, what if your outlook is that we're going to 650 by January of next year? Well, now that starts to make sense because this option would be worth $45 at that time. And we're only spending $6.50. So when we start thinking about it, we're making $3,900 if that were to actually play out. Now, again, it circles back to, well, what is the actual probability of that occurring? Probably not too high, right? And we could actually figure that out if we were to expand to all strikes. And Jake, I'm sorry to make you work here, but if we were to go and look at, well, what's the 650 options delta? This will actually give us an approximation for that. So if we were to look at the 650 right there, it's telling us, well, there's about a 5% chance of that occurring. So is that worth it to us to get more leverage to spend? And of course, you don't have to spend the same amount of money. You could just buy one of those options and spend way less. And if it works out, it works out. But that's kind of the idea here is if you get that really, really outsized move, and that's what you're expecting, the out of the money options give you that convexity. That's the whole idea here. Now, I saw another question here about this topic, and it comes from Cliff. And Cliff, this is an excellent question. I appreciate you bringing it up. So Constantine often talks about market deltas, the 5, the 25, the 10, when referring to at the money, near at the money, and skew. Can I discuss that? So yes, what he's doing there, and this will be a great little primer if you're wanting to attend that class, because he does talk about some higher IQ topics in there, and he kind of expects you to come to the table with a baseline of knowledge. So let me dive into what he's actually talking about, and we can see it right here. So when he's looking at the IV for the 30-day out options, effectively what he's doing, and this one's farther out, right? We're in the January cycle, but just forget the date for a second. All he's doing there is he's going and looking at what the implied volatility values are for the options that have a 5 delta. So in this case, this would be the 650. Then he's going up and looking at the 10, which would be the 635. And then sometimes he'll look at the 25 delta, which would be the 605. Notice those are all out of the money options. And what he's typically in that class doing is he's comparing the implied volatility values. And I don't want to skip too far ahead here because we're going to talk about Vega in a moment. But he's comparing the implied volatility values for the calls versus the puts. And usually what happens is as you go out of the money in something like an index like SPY, the put side is going to have a higher implied volatility. And the rationale behind that is because people are much more willing to pay for insurance to the downside than they are to speculate on the upside. Because most people are long in a portfolio and they're in a situation where they're looking at, I'm really scared if the market goes down. I don't want that to happen. But if we go up, that's fine. I'm already long in my portfolio. This is a good thing for me, right? So that's why he's looking at that. And it's not a static situation. It's always ebbing and flowing. And you'll see scenarios where the volatilities will flatten out. So there's a skew where puts are higher on this side, they're low on this side for the calls. And sometimes that'll flatten out. And that's the relationship that he's trying to decipher in that class. And that's what he's bringing to you. I don't want to steal all his thunder. That's not the point of this one. But hopefully, Cliff, that made a little bit of sense in terms of what he's attempting to accomplish when he's showing you that type of material. So, Jake, I want to pause there because I know that was dense. I'm going kind of fast here. Anything that you wanted to add to Delta before we hop over into some of the others?
Delta is an interesting one. It has so many valid interpretations. Like you said, there's the share equivalency, there's the probability. I will just add a little caveat there to the probability idea. Probability using delta is assuming a few things. When we talk about probabilities, folks, probability is always based upon some measurement of volatility. When you say there's a 50-50 chance for the coin to be heads or tails, it's because there's an implication there that you believe that the coin is a fair coin, that heads and tails are equally likely. We also have an idea based on how many times we might flip a coin, how likely we are to be near 50-50 results or farther away. So there certainly is a few different ideas along the way. So when we consider probability, it's important to know that the probability here for delta is based upon the volatility of the implied volatility of that contract, which we see does change depending on which one we're looking at. That 605 that we were exploring had an 11.5% implied volatility, whereas the this lower one that we took a look at, let's bring it back to just those 20 strikes. I think it was the 510. Yeah, there it is. The 510 was implying instead a 17.5% implied volatility. So there is a little bit of discrepancy and difference between them. And the higher this number, the less reliable delta acts as an approximation of probability. SPY, in almost all cases I've witnessed, has been in a range where it's reasonable to make that assumption. But if we take a look at a stock that also trades a lot, we might find that the values are very different. Take a look. Here on Tesla, we're looking at 55% presently. If you took a look at a stock that currently has a huge amount of volume as a result of some news announcement, maybe a drug creator that just is about to or just had their FDA approvals go through or fail to go through, a company on the brink of a merger or other big events, we will find this implied volatility ramps up in big ways. Even if we were to take a look at a stock that may be relatively stable, like JP Morgan, but we look at options that have a very short time frame and a known event like JP Morgan's earnings tomorrow morning, that's going to increase our overall value on these as we work through the session. Now, as we consider that implication, there's a lot that we need to understand. Some of the most important are, first and foremost, that as the implication for a movement happens, we might view these as high or low. And I typed out an answer to a question on this, but I think it's one that bears discussing for all of us. There is some rhetoric out there from so-called option experts on the internet that say that when volatility is high, you should be selling. And when volatility is low, you should be buying. And that might be true, but let's take a look and see how one might view those. If we take a look at SPY, right now, volatility is at the 12th percentile. The lowest it's been over the last year is 9.5%. And right now we're at 10.5% volatility. Whereas the highest it's been in the last year is 18.5%. So on a relative scale, we are very low on the implied volatility. So some people would say that means you should favor option buying strategies. But that assumes something crucial that those experts tend to leave out. At least in my experience, that's what I have observed. The reason that you would say, yes, you would favor that is if you believe implied volatility will rise. You believe implied volatility will rise, or at minimum, that it is an understated. It is too low because it will actually move by more than is implied. That's why an option buying strategy would be favored, because it is too low and you expect it to rise. When we took a look at Tesla and see that right now it's near the high end of its implied volatility, that does not mean it's too high necessarily. What it means is it currently is very high compared to history. But if you look at the Tesla chart, you understand when its earnings is about to come up, and you come to the conclusion that you think the stock is likely to move at a clip more associated with a 75 or 80 or 100% volatility, you would still favor option buying strategies because you believe this is to be too low. So remember always, if you say it's high, so I should sell, no, 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 no. I believe implied volatility will go down, so I should sell, putting Vega on my side. As an option seller, Vega would mean that now if volatility goes down, we win. Whereas as an option buyer, that would be an additional uphill slope that our stock's price would have to offset in order for this to occur. This is extremely relevant in the current environment because JP Morgan is not the only stock that's about to announce their earnings, but rather we're on the cusp of all stocks reporting their earnings. Over the course of the next several weeks, the vast majority of the S&P 500 and the rest of the stocks out there are going to be announcing their current earnings. That's an important factor. Now, as we evaluate this, I want to make sure that everybody understands some of the ins and outs related to that overall condition. So let's jump back in and take a look at a few other items here on the slides, and then we can circle back to a few other examples as we work through them. The next thing that we need to consider as we look at our slides, we already learned a bit about delta. We learned a little bit about gamma. Let's see if we can't talk through a couple of these in greater detail. So gamma, folks, is the representation of how our delta will change. If the delta was 50 and then the stock goes up by $1, since gamma at that moment was 10, our new delta should be approximately 60. Gamma would also have changed during that time. All the Greeks are changing all the time. It would end up being lowered about 7%. You could think of gamma as how hard it has to work to move delta from its current value to the extreme. The highest delta could ever be is 100, and the lowest it could ever be is 0. There are, of course, also negatives, but in each case, it's going to range from 0 to either 100 or 0 to negative 100. So how hard does gamma have to work to push it from 50 to one of those extremes up to 100 or down to 0? It has to work really hard. In fact, some of the hardest. But as it gets above it, gets to 60, well, now it only needs to move an additional 40 points to get there. Hence gamma decreasing as it's moved a little closer in that direction. Now, we will look at this example and understand it, but the key is when we look at gamma, gamma is going to be most associated with shorter term options. If you look at an option with 6 months, a year, 2 years, did you know there's options with 2 years of expiration time frame? Their gamma will be very small because, again, there is more time for gamma to do the hard work of pushing it to either 0 or 100. That time makes a difference. But if we're looking at an option that expires tomorrow, take a look for us one more time over here at the options chain here for JP Morgan. Right now, delta is 40, 60, or some other value. If we add in here as well the column labeled gamma, we'll find that it's going to have to move pretty strongly in order for the security to see this move up or down. Now, gamma, I think, can get a little bit confusing for a number of reasons. First off, because it's just a complicated idea in the first place. But we also need to recognize that this is on the basis of how much delta will move for a $1 movement in the stock. $1 is important. With delta, we could kind of forget about the fact that it was only $1 because this was moving and added up to a sum that made sense based on those dollars. Gamma is moving the range bound delta to 0 or 100. When it moves by $1 here on a $200 stock, that's not as meaningful as a $1 move on a $10 stock. Let's jump over and take a look at Ford Motor, a lower dollar stock. It also has its earnings coming up, and we will find that its gamma looks a lot higher because $1 movement on Ford is a 10% move. That's a big deal. Whereas if JP Morgan moves by $1, that was half of 1%, almost nothing on a respective basis. So we need to measure and understand that gamma is not a comparable value from one security to another unless you adjust for the stock price. As a result, my inclination in general is to think of gamma as almost a static value. What I do when I think about gamma is I look and I compare how does the gamma of my Ford options look for this July 26th earnings right after its earnings event? And how does that instead look out here to January 17th? Let me narrow this down so we can see it for just a couple of strike prices. And we can see the gamma for the short dated option. Wow, is it exaggerated compared to the long dated option? In this case, already 3 times the value. If we bring it in and look at the one that expires in just a few days, just tomorrow afternoon, now it's 10 times the value here. It will dramatically affect the value for that option. $1 movement right now for Ford would be a make or break it for the security. So that would definitely be the difference as we consider these back and forth. Anything else you'd add here on Gamma, or do we continue on to the other players in this?
Yeah, I mean, I'll just say one quick thing about gamma. Basically, there's a trade-off. I'm going to try to describe this qualitatively, so it's trying to make sense less from the mathematical perspective and just more from what is the perspective that we're really trying to gain from gamma. And the reality is, gamma becomes more sensitive as we get closer to expiration, and the reason, especially specifically for the at the money options, and the reason why is because gamma's job is to get the options delta to either 0 or 100 or negative 100 or 0, one or the other, right? That's its job. It's trying to drive the option one direction or the other. And if we think about it, if we're one day to expiration and the at the money options are still supposed to have a 50-ish delta, well, gamma has a lot of work to do, because at the end of that day, the option has to be either worth something intrinsically or it doesn't. So it's going to have a big job. And the point of this is options tend to get a lot more volatile as we get closer in terms of their percentage moves. And again, Jake, I just have to show this, right? And hopefully, crossing my fingers here, Active Trader Pro is going to cooperate with me as we're showing this. And I'm come back to this example, but if we're looking at an option that's expiring today, for example, so we're looking at, and we'll use, where is SPY at right now? 55.90, we'll say. This option. And let's go to today's value on this. No. Okay, there we go. So notice where, and actually we can do the last 2 days. Look how large this thing can move. So this is literally yesterday at 11:16 in the morning. Look how quickly this thing was able to move. It went from there to here, up 188%. Notice what happened today, though. We're down 81%. And granted, we've moved a lot today. I mean, this is a pretty large down day for us. 41 handles down, haven't seen it in a while. But that's a really, really fast moving option. And I mean, we're talking about less than 1% down, and this option is losing 81%. And again, the reason why is because this thing expires at 4 o'clock today. So it either has to be worth something or it doesn't. And we're right here at the money. Now, if we were to go and look at the August 16th date for the same at the money option, it's still going to move. First of all, notice that the volume on this is way less. But if we go to, this is 10:30 from yesterday, it still moved. You got a 30% gain from 10 o'clock in the after, or 10 o'clock in the morning to basically the high in the open this morning, and it moved down, but it's 25%. So this is the importance of gamma, is understanding that the percentage moves of the option are going to be greater. And especially if you're a seller of options, I would say something that seemingly is in the out of the money, but we're getting closer and closer. As we get closer and closer to at the money, that thing could go from a profit to a loss like that. So there's different ways of handling it. There's different ways of approaching it. But as you get closer, there's just no doubt about it. Gamma's job is going to make the option more volatile in terms of its ability to move. And as you go further out in time, that's going to be less the case. So it's a good and a bad thing, right? If you're looking for the more sensitive option, the one that's shorter term is definitely going to get the job done. But you better be right and right quickly, because if not, you wind up with an 80% loss over the course of a couple of hours. If you go longer term, that's fine, but it's also going to be less sensitive. So if we get, the move that you're looking for is pretty monumental, the percentage return is not going to be as great. So really the question you have to ask yourself is, where is my personal sweet spot? There's a lot of activity and a lot of attention being given to 0 day to expiration options, weekly options, and that's great. I get it, right? It's very, very rewarding when you're correct. But if you're not correct and correct quickly, there's very, very a very small margin of error. Whereas if you go too long, well, maybe you have to have a longer term thesis that makes sense. So finding that sweet spot, which is why a lot of people on that 1 to 2 month to 3 month range, because you're kind of getting a little bit of both. It's somewhat reactive, like this one. This is basically a month out at this point. It's moving, but it's not completely dead if you're completely wrong over the course of a 24-hour period. So I just wanted to highlight that, Jake. And I'm going to jump right into some of the questions about volatility, and we want to talk about Vega next. So let me just hit those and take this topic, and then I'll let you circle back to maybe Theta and Rho, and I'm sure you'll have some color on this one as well. But one of the questions that we got was, can you explain the difference between IV, vol percent, and IV rank? And there's a couple of things that you got to know. So the best place to view all these things is option statistics, and we'll just look at it for SPY right now. So there's the IV value, which is the IV 30 and 60 and 90. So what it's doing is it's trying to go out and look at an option, and it's basically doing a VIX-like calculation. It's not quite the same as VIX because they're using at the money strikes only rather than going far out on the wings, but they're trying to do a similar calculation to what VIX is and come up with this value. And basically what this is telling you, on an annualized basis, if we're to go out a year from now, how much options pricing is telling us the stock is going to be up or down. So if we're looking at SPY right now, it's saying that if we were to go out 1 year from now, based on how the options are trading 30 days out, we should be either up or down 10.71%, two-thirds of the time, because that's within a one standard deviation calculation, right? So that's what it's telling us. It's not guaranteeing that. It's saying with a somewhat probable degree of certainty, 67%, this is what we're predicting. Obviously, 67% is not 100, which is why there's an option market and why there's people willing to buy and sell. The way that we can also use this, if we were to look at that where it's 10, now let's look at Tesla. So Tesla is looking at an IV value of 66.82. So the way those options are trading right now, what is that telling us? Well, it's telling us that Tesla is either going to be up or down 66.82%. Now, is that reality? Maybe, maybe not, but that's how the options are trading, because there's so much, I would say, speculation that was going on in the last couple of days, and now we're seeing an absolute collapse in the stock price, and you can see it's on its higher end. So that's the IV value. Now, options themselves also have IVs. So when we go and look at these, we can look at the IV for the actual individual contract. And it's going to be, if we're looking at the ones that are 30 days out, the ones that are at the money, they should be pretty close to the IV 30 value. And that's how we're getting the IV 30 value. But you can look at these individual ones. And then, as we were kind of showing everybody on the earlier topic, as you start to slide out of the money here in terms of the calls, going a little bit down and then up, and just lower strikes tend to have that higher volatility. And then you can compare across from calls to puts. But basically, what this is trying to represent for us is individual contracts have their own volatility, which is why when you see big moves in one direction or the other, sometimes on individual names, IV can start to rise, not just because we're going down, but also because we're going up. And that's the case for Tesla. If you look at a chart of Tesla, I know today it's down massively, but before that, I mean, it's about as vertical up as it can possibly get. And let me go to a 1 year here. I mean, you see the verticality in the up move, and that's why volatility was rising, even though we were going up. Usually it's the opposite, right? That's the more normal condition, but for individual stocks, it can do both. So that's the idea behind just the basic value of IV. Now, there was two other ones here. There was the concept of IV percentile, and then there's IV rank. And we call what other firms would call IV rank, we're calling IV percentile. So what that's trying to tell us is looking at the 52-week range for implied volatility for Tesla, low end 39.53, high end 71.12. And it's saying, okay, well, if we take 66.82, what percentile would that fall in within that range? And if you hover over that little triangle, it tells you the 86th percentile. So that's high. It's in the upper quartile for volatility. Now, if we were to look at SPY, I know volatility is going up a little bit today, but you can see the exact opposite condition where it's in the lower quartile. We're in one of the lowest volatility environments we've been in quite some time, right? So that's what it's trying to tell us is relative to itself, whereas its own volatility. Whereas if we're looking at the IV30 value, we can compare, and right now we're clearly able to say that Tesla as a security is way more volatile than the S&P 500 tracking ETF by about a magnitude of 6x. And then the IV percentile in we I'll just say the name because I think they're the ones that came up with it. Tasty Trade is the one that sometimes talks and references that. The way they're defining that is very similar to the concept here. They're looking at the IV range and they're looking at the current volatility percentage or the value, and they're saying what percentile or what percentage of days have we been below that volatility. So that's all that's trying to tell us. We don't actually have a way to view that here on Fidelity.com or Active Trader Pro. One of the free sources I know that if you're really interested in that metric, barchart.com is one that offers it. Frankly, in my opinion, I know that they're slightly different, but this is kind of giving you a similar idea. It's obviously not exactly the same, but we're trying to understand, are we on the lower end of volatility or are we on the higher end? Where that one's helpful is if we have like an extremely high or outlying reading in the volatility. Now, why does that matter? Well, because volatility changes can also change our options, sometimes so much so that price doesn't even matter. It's not that it doesn't matter, it's that price doesn't have to be doing anything. Usually it is. It's not operating in a vacuum, but there's situations, for example, we had a CPI print this morning. And you can see sometimes in the pre-market where options premiums will start to increase, even though we're not necessarily even going anywhere leading up to the event. And it's because people are rushing out there and the demand for options starts to get higher because they don't know what's going to happen and they want to ensure that they're protected in some way, shape, or fashion. So that in and of itself, if there's demand and the same amount of supply, well, supply will realize, hey, they keep biting these options at this price. What if I raise it up a little bit? And they keep going. Well, what if I raise it more? And if that demand persists, what's that doing is driving the price of the option higher. And that's really what volatility is trying to reference for us is what is the current prices of options? Are they high or are they low? And that's why we look at percentile because it's telling us a relative qualitative description of are they high or low. So that's what it's trying to represent. Now, when we go back to the slides here and we're looking at what Vega is actually trying to tell us, it's just saying that if we were to have a 1 percentage point change in implied volatility, how much should my option change? And the reality is oftentimes when volatility changes, it's not in 1 percentage point, right? It'll go from a 12 handle to a 13 handle. And you can see that from VIX. over the last couple of days. But if you are looking at this and you're saying, okay, well, I have an option Vega of 0.05, then how much should my option gain or lose if we're to go up 1 percentage point? And the answer, of course, is 5 cents, right? So it's just trying to represent that for us. And we do a whole separate class about what you need to know about volatility. We could probably spend an entire day talking about this topic, and that's why Constantine does the volatility primer to give you a sense of the volatility environment that we're in. He does that on Wednesdays at 1:30. But it's important to understand this because I think this one is often neglected and people don't consider it. And really, this is almost as important, if not equally important, to the directional nature of the trade. Because even if you're right, if volatility is really high, what if it didn't move enough in your direction? So you're right on the direction, but you picked an option that was way too expensive and you actually end up losing money. For example, and I know we're running out of time, so this will be my last comment on this, and I'll kick it back to you, Jake. We go over to Tesla right now. We saw that those options are relatively expensive, and we're down today. So let's just imagine it stabilizes here at around 245. If we were to buy this option for, and let's actually make it more drastic, let's use the one for tomorrow. So if we were to buy a 245 option, it would cost us $5 and we'll say 50 cents just to make the math easy. So what we're saying is we need Tesla at 250 and 50 cents by expiration just to break even on the option. So the problem here is people could say, oh, and I'm hopefully not talking about anybody in this class, of course, but there's probably somebody out there saying right now, oh, look at how high Tesla's gone in the last few days. This is an overreaction. It's down $16. It's going to come back. It's going to go up tomorrow. And it very well may. I'm not saying that it might, and maybe it goes up $16 and they hit the nail on the head. But what if it only goes up $3 tomorrow? And they paid for an option that's worth $5.50. Guess what? They are going to lose money if they hold that through to expiration based on the value of the price. So it's very important to understand this concept of volatility and how Vega will affect the option. It's also very important as we get into earnings season to understand that typically the way it works is volatilities remain higher into the earnings. You can probably see it here, even though volatility is high. They typically remain higher, and yeah, you can kind of see, right? As we go and look at, why don't we do 5 strikes? So we can kind of all see them. So if we go to next week, obviously this week's are higher because of all the movement that's happened. But if we go to next week, it flattens out a little bit, and the 245s are back to 61. But we go to July 26th, we're back at 80, and that's because guess what? There's an earnings event. So a lot of times people go into earnings season thinking, oh yeah, I think this is going up or down. They have no consequence of what's being priced in, and they end up getting the direction right, but the volatility is not great enough in said direction, and they lose money. So just be mindful of that, and that's the importance of Vega. Jake, I know we're running really short on time here, and we still have, I guess we kind of talked about Theta, but anything else that you wanted to add to Vega before we move on here?
Yeah, it definitely is just worth understanding, folks. Make sure you're aware of it. Make sure you're watching. Um, because earnings results in a predictable expectation of a decrease in implied volatilities, especially right now, if you're trading options on individual stocks, you need to recognize that a decrease in implied volatility is extremely likely following the event. And then whether or not the stock has moved by enough to make up for that is what determines whether or not an option buyer is profitable. And vice versa, the decrease in implied volatility will be a benefit for the option seller. And then it's their risk if the stock moves by too much in the wrong direction. So all of this is certainly relevant as we work through it. We'll leave you with just one or two thoughts here in relation to theta as we walk through and leave this class. The phenomenal questions, as well as kind of our tendency to get a little bit deep into the weeds here as we talk about this concept, has taken a few minutes away from us. But folks, when we think about theta, the key is that option buyers have to overcome theta whittling away at the value of their option. Option sellers are using theta as their slowly, but surely path to victory. For an option buyer, it's the death by 1,000 cuts idea with theta. It might be only 5 cents per day, but 5 cents per day every day might end up being a substantial sum over time. Options values do change over time, and those option chains will reflect the update. Theta may start at 0.05 at first, meaning it would have a 5 cent loss in the value of the security for a 1 day passage of time. But thereafter, it may go up. As we get more and more detail, again, I have up this Ford Motor idea. Let's go ahead and add theta to our options chain. And with this same spread of different dates, we can see how the addition of extra time changes the amount 1 day's passage will impact it. The 13.5 option expiring tomorrow will lose all 6 cents worth of its value, almost every penny's worth, by tomorrow if nothing else happens. The one that's got 15 days, well, it's still going to lose a decent amount, a penny and a half, which on a 40-cent option is still 2.5% of its total value. Whereas this one, the long-dated option, has such a small theta value, it's negligible. If you told me it was 188 or 190, but it's 190 days, it turns out. 1 day difference doesn't make any difference. Meanwhile, for the option that expires tomorrow, I can count how many hours away this is. Every minute matters here. If you choose to get into the absolute extreme view of trading 0 day till expiration options, options that expire today, your theta, although it's displayed here in a 24-hour format, is realistically measured in minutes, in seconds. Every tick of the clock is money that's costing you to have that investment as a short-term option buyer. Sellers of options have that opposite. So be aware, be watching that closely as we work through it. We are at time and a little bit beyond. I hope you've enjoyed this idea and that from now on, the Greeks will feel just a little bit more familiar than they have been in the past. Add them to your options chain. Watch it change over time. Ask yourself, do you expect the stock to go up, down, or sideways? That's your delta, directional outlook. How do you expect the current implied volatility to change? It may be that it is high relative to history, as Matt showed us. Does that mean it is too high? Does it mean it's going to come down? Maybe, or maybe not. Your trade will be based on what happens from here forward, not from here backwards. What is your volatility expectation? Will that change in volatility help or hurt you? And is the trade still worth it? Finally, T for theta, include in your analysis some measurement of time. I know that you don't know the future. I don't know the future. Matt doesn't know the future. But nonetheless, your money is making a bet on the future. So like it or not, you must have an outlook on when the directional outlook you expect to have occurs. If it does not, then you will be wrong, and that may lead to a losing trade. The better your outlook aligns with the actual future, the more profits your trade will have. So doing your best to develop those outlooks effectively is one of the keys, as long as you have taken the time to verify that your Greeks, your delta, your gamma, your theta and vega, maybe even rho, that they line up with that outlook in an appropriate way. So thank you so much. I appreciate the time. We did have one request wondering when this class will be scheduled. This one is one that we teach usually about once a month. So keep on the lookout. The schedule for August is not yet published. So we'll add a note. If there's space in the schedule, we'll add it back in for the month of August. Not yet on the calendar for now. So until next time, folks, we appreciate the opportunity to spend a few minutes of our time with you. It's been a bit of a wild day for the S&P 500. Let me just close with a quick chart here showing you where we're at. Right now, the S&P 500 is down by almost a full percent. If we take a look at the pre-market, however, we see that we were up by as much as 0.5% early in the day when we got good news, or seemingly good news, in relation to both CPI, an inflation-related metric, as well as related to jobless claims. Good news from both of those was enough to buoy up the market, but only very temporarily. It's been all selling ever since, putting us now in a state where perhaps we have found ourselves lining up with the 5-day simple moving average and now need to ask ourselves where we go from here. So if you'd like an update on where we end up and how we got here, I'd encourage you to join us for the afternoon market briefing this afternoon, right at the market close, 4 p.m. Eastern time. You can find those sessions at fidelity.com/coaching, and it'd be our pleasure to see you there. Until then, Matt, thank you. I appreciate everybody. Take care.
Absolutely. See you next time.